Hey everyone, welcome back to the Web3 Daily. So, let's talk about what's happening in the market today. You've probably felt it. The moment the Fed started talking, it was like a cold shower for the entire market. Everything just cooled right off. We're seeing the major assets pull back a bit, which can be a little nerve-wracking. But honestly, I think that's just what's on the surface. If you look closer, there's a lot happening underneath. The big institutional players, their money isn't sitting on the sidelines. And you can feel that market confidence slowly but surely creeping back. So even though things are a bit choppy because of all the macro news, I'd say the market's foundation is still looking pretty solid. Today, let's dive into a fascinating topic starring someone everyone in the space knows. Changpeng Zhao, or CZ. The Hurun Rich List recently put a number on his wealth, estimating it at 190 billion RMB. The moment that figure dropped, the whole community went wild. But what's even more interesting is CZ's own response. He posted on the X platform saying, "Nonsense. Divide by 100 is more like it. Divide by 100, that would leave him with just 1.9 billion. Honestly, when I first saw that, my gut reaction was, that's ridiculous. He's got to be joking. I doubt anyone in the crypto world believes that number, probably not even himself. But that's what makes this so entertaining." CZ's casual, dismissive comment immediately created a massive stir in the community. Instead of believing him, many people took it as a sign that the Hurun list didn't overestimate his wealth, but actually underestimated it by a huge margin. Why? Their logic is pretty straightforward. They look at Binance's quarterly BNB burn. Take the most recent one, for example, which was worth over $1.2 billion. If you use the old formula from the Binance white paper that the value of burn tokens equals 20% of quarterly profits and work backward, it implies Binance's quarterly profit is over $6 billion. That's more than what Alibaba makes. By that math, CZ's real fortune could be far beyond what any rich list imagines. Of course, there's a catch to this calculation. No one knows for sure if that 20% of profit formula is still in effect, and Binance has never officially clarified it. So, the whole thing has become a sort of Rashomon mystery. But in my view, the exact number of CZ's wealth isn't the point anymore. What matters is times he responded the way he did. I see it as a brilliant PR move. Think about it. He just received a pardon and is now advising various governments as an industry expert. At this critical juncture, having the title of a multi-billionaire just paints a target on his back for regulators, especially politicians like Elizabeth Warren who are constantly scrutinizing the crypto industry. So, by using an almost absurd divide by 100 line, he instantly turned a serious discussion about his wealth into a viral meme that everyone can joke about. It's a much smarter play than trying to seriously explain his finances, isn't it? He's actively lowering his attack surface, putting on a layer of camouflage. That's a master stroke, truly. Alright, enough about CZ. Let's get into the heavy-hitting news. Last night, I bet every single trader was glued to their screen waiting for the FOMC meeting. And the news dropped, a 25 basis point rate cut, bringing the target range down to 3.75 to 4%. Now, this was pretty much what the market expected, so it should have been a small piece of good news. But the real drama started at the press conference afterward. When Powell started talking, the whole mood shifted. He said something very telling that another rate cut in December is not a foregone conclusion, far from it. The second he said that, the market just imploded. Everyone who was hoping for the easy money to keep flowing just got a bucket of ice water thrown on them. And how fast was the reaction? In the hour right after Powell's speech, over $300 million in crypto derivatives got liquidated across the board. Bitcoin's price took a nosedive too, dropping from a high of around $113,700 straight down to below $110,400. So you see, the game has changed. People aren't trading the rate cut itself anymore. They're trading the time's expectation, times of future rate cuts. This is a classic hawkish cut where the good news becomes the bad news the moment it's confirmed. Powell just injected the market's biggest enemy, uncertainty. It just goes to show that our crypto world is now completely tied to the global macroeconomy. We're not in our own separate kingdom anymore. So while the macro environment is keeping us on our toes, on the other side of the coin, real-world adoption is moving full steam ahead. The payments giant Visa is making some massive moves again, and they are seriously expanding their stablecoin settlement platform. This isn't just some minor update. They've added support for 2 more US dollar stablecoins, PayPal's PYUSD, and the global dollar USDG, and they've also brought Circle's euro-backed stablecoin, EURC, into the fold. But here's the kicker. On top of their existing support for Ethereum and Solana, they've now added Stellar and Avalanche to the mix. How big is this play? The numbers don't lie. The annualized transaction volume for Visa's stablecoin-linked services has already blown past $2.5 billion. When I saw this news, one phrase came to mind: a network of networks. What Visa is building here isn't just another payment app. They're quietly using blockchain to construct a global settlement layer that could one day challenge the SWIFT system. They're integrating different chains and different stablecoins into their massive network, allowing traditional financial institutions to plug into the efficiency of blockchain as easily as plugging in a USB drive. It's a brilliant move, basically a Trojan horse for the financial world. And think about what Visa's endorsement means. This is the kingmaker effect in action. When a giant like Visa publicly backs Ethereum, Solana, Avalanche, and Stellar, it's like giving them an official enterprise-grade seal of approval. The potential that unlocks for their future ecosystem growth and institutional capital inflow is just immense. And speaking of Solana, it's been having an absolutely massive week. It's not just the Visa news, the ETF space has also entered a new era. The asset manager Bitwise has officially launched the first ever spot Solana ETF in the US with a ticker BSOL, and its performance on day one can only be described as explosive. Trading volume hit a staggering $56 million, making it the strongest debut for any new crypto ETF launched in 2025. Now, of course, you can't compare it to the massive multi-$100 million launches of the Bitcoin and Ethereum ETFs. That was a different league. But for an altcoin ETF, this is an incredible result. Plus, this ETF has a killer feature. It has a built-in staking strategy, which aims to pass on Solana's average staking reward of around 7% directly to the ETF investors. What I find most interesting about this is the completely new narrative it introduces to the market. When we talked about the Bitcoin ETFs, the story was digital gold, emphasizing its role as a store of value. But now, BSOL comes along and tells Wall Street that Solana is a yield-bearing digital commodity. In other words, you're not just buying a high-growth tech asset. You're buying a productive tool that continuously generates income for you, just like a dividend-paying stock. For traditional fund managers, that narrative is far more compelling. What's more, the success of BSOL sets a new precedent for all future proof-of-stake altcoin ETFs. It's likely that going forward, the market will just assume that if you're launching a PYUSD ETF, it better come with staking rewards, or it's not even worth considering. This move has just raised the bar for the entire game, and the Solana story doesn't end there. If the Bitwise ETF opened a window for Wall Street, then this next piece of news kicks the main door of traditional finance wide open. The legacy remittance giant, Western Union, has announced it's going to issue its own US dollar stablecoin, called USDPT, on the Solana blockchain. This, in my opinion, is the real heavyweight news. They've got Anchorage Digital for custody and are planning to roll it out starting in 2026, initially targeting key remittance markets like Latin America, Africa, and Southeast Asia. But the most incredible part isn't just that they're launching a coin. It's that this coin will be deeply and directly integrated with Western Union's existing network of 4,500 global fiat corridors. What does that mean? I call it the invisible rails strategy. Western Union has no intention of turning its hundreds of millions of customers into crypto pros who manage wallets and private keys. It's simply using Solana as an invisible, hyper-efficient settlement track on its backend. For the average user, the remittance experience will feel exactly the same. They'll use the app or go to a physical location. The entire blockchain process is completely invisible to them. The only thing they might notice is that their money moves faster and cheaper. This brilliantly sidesteps the biggest roadblock to mass Web3 adoption: the complicated user experience. Of course, for Solana, this is also an epic stress test. How big is the global remittance market? $860 billion a year. Even if just a fraction of that volume runs on Solana, it's going to be a massive load. If they pull this off, Solana will truly become the go-to platform for traditional financial institutions. But if it stumbles, say, another outage, it would be a devastating blow to confidence in public chains. After covering those specific projects and products, let's pull back and look at the global regulatory landscape. There's a new development out of Australia that I think is really worth paying attention to. The Australian Securities and Investments Commission, or ASIC, has officially declared that stablecoins, tokenized assets, and wrapped tokens are all now classified as financial products under their existing framework. This decision means that anyone wanting to do business with these assets in Australia has until June 2026 to get an Australian Financial Services License, or AFS license. The way I see it, Australia's move here is incredibly smart, and it's a perfect example of the principle. Boring is bullish. Instead of spending years creating a brand new, complex regulatory system just for digital assets, they've simply slotted stablecoins into the rulebook they've been using for decades. What's the advantage of doing that? It's fast, and it provides certainty. It gives the market a clear, predictable path to compliance. For the big institutions looking to enter the space, a clear rulebook, no matter how strict, is far better than fumbling around in a regulatory gray area. This is going to accelerate a flight to quality in the market. Think about it. Getting that AFS license won't be cheap, and the operational standards will be high. This will naturally weed out the smaller, weaker projects that aren't well capitalized or properly run. The ones left standing will be the major compliance-focused players like Circle and Paxos. So, in the long run, this regulatory pressure is actually helping to clean up the stablecoin market, increasing its overall stability and trustworthiness. Finally, let's look at a piece of news that could reshape the entire market landscape in the future. We've talked about the Bitcoin ETFs, we've talked about the Solana ETF, but those are all focused on single assets. Now, ProShares is already making the next move. They've filed an application with the SEC to launch an ETF that tracks the CoinDesk 20 index. When I saw this, my first thought was, here it comes, the S&P 500 of the crypto world. This index bundles up the top 20 major cryptocurrencies by market cap and liquidity. We're talking Bitcoin, Ethereum, XRP, Solana, and so on, but it specifically excludes stablecoins and meme coins. In my view, this signals that crypto assets are entering the final mature stage of financial productization. Think about the evolutionary path here. In the beginning, we all had to manage our own private keys and wallets, which was a huge barrier to entry. Then came the spot ETFs for single assets like Bitcoin and Ethereum, which made investing easier but still concentrated all the risk in one asset. Now, what ProShares is doing is the third stage. It gives investors who are bullish on the entire digital asset ecosystem but don't have the time or expertise to pick individual winners a one-click tool to go all in on the whole sector. For wealth managers in the traditional world, this model is incredibly familiar and appealing. And if you think one level deeper, once this type of index fund becomes widespread, just being included in the index will become a massive catalyst in itself. When tens of billions in passive investment flows into the market through these ETFs, whether a project can make it onto the CoinDesk 20 list will directly determine its capital inflows and market valuation. In the future, the quarterly rebalancing of this index could become a major market event that everyone watches. Just like the S&P 500 rebalancing is for stocks today. Alright, that's all for today's Web3 Daily Report. If you found this helpful, please remember to hit that like button to show your support. Every day, we sift through the Web3 world to find the most important news that's closest to the money. And we hope that by breaking down these key stories, we can help you make more rational and informed decisions on your investment journey. Also, I've prepared exclusive sign-up links for all the major exchanges in the comments section below. These are high rebate deals we've secured specifically for our viewers to help you save on costs. Let's all stay rational, keep moving forward steadily, and build our wealth step by step in the world of Web3. May everyone's crypto assets grow steadily, and we'll see you again tomorrow.